Hello and welcome to March's episode of Capital Markets View. We hope you are all well. Taron, hello, how are you?
I am good. I am just back from Fuerteventura, which was amazing to get away. This was the trip.
Holidays.
Yeah, this was the trip that I was supposed to go on in March 2020. So I think I've moved it. I moved it about six times.
Oh my God. We're about to get on a plane this Thursday to go skiing for the first time in about 3 years. So a bit late in the season. I'll tell you when next time we're on this whether the snow was a bit slushy, but the first time on a plane. Wow, it's stunning. Do you want to say your lovely words?
Yes, I just wanted to tell our viewers that the activities of LCD are independent and separate from S&P Global Ratings. S&P Global Ratings maintains a separation of analytical and commercial activities, and as was announced back in October, LCD will be divested from S&P Global.
Thank you very much. And as you might be able to tell as well, my radiator has finally gone. It is no longer in shot. Yay! It only took 6 months to get a plumber. Right, so let's go to the first slide, which is annual European leveraged loan volume. Now, of course, actually, what we're probably going to talk about, what we will talk about mostly during this episode is what's going on now, but I guess also importantly, where we think things are going to go. So if we look at year-to-date 2022 compared to year-to-date 2021, not surprisingly, it's lower. It's about half. That's because there's been almost nothing. Well, there has been nothing other than an add-on or two in March. So sadly, because the syndicated loan market used to carry on during crises, but it now mimics the bond market more, and it's been pretty much closed for the whole of March. In fact, the last primary deal was IVC Evidencia, coming out at a yield of about, it was an add-on, 5.3%. That was an add-on that they did. And then the last primary deal was Arma IMAC at the end of February, which launched at 4.7% yield approximately and closed at 5.5% yield. So no primary, an add-on. What do you think, Taron?
Yeah, that was a privately placed loan, the IVC one. So it's actually, we've got a lot of questions from clients on this because we're not including it in the broadly syndicated volumes. So, it is, it was done, but it was done privately and sort of pre-placed in that way. But yeah, it looks like yields to get something done, it's got to be above 5%.
Yeah.
That was the OID wasn't public on that, but our journalists were told that it was priced at 97.5 at a discount. So yeah, I think any new issues have to take into account where the secondary market is trading. And the LE was down on Friday at 96.52. So, if you don't have to go to the market to raise capital, obviously issuers are going to be waiting. I've been hearing that there's lots of early bird discussions out there.
Okay.
And potentially, we could see some deals before Easter. However, it is price sensitive, and potentially maybe even it would be a privately placed deal like IVC. So yeah, and just to mention, we're talking about loans, but also there has been no high yield bond issuance either. The last deal that we had was a tap February 16th, and it's been 36 days since the last benchmark issue. And just for reference, there was a 47-day gap when COVID-19 hit.
Okay.
So we're getting closer to that gap on the high yield side.
So I remember the last time we got together, I was saying about 4 weeks, and then I must admit, in the meantime, I've been getting feedback directly from private equity that banks are doing underwritings, but nobody really knows when the primary market is going to completely reopen. However, I read in LCD rumours of the Unilever tea business possibly coming out after Easter. So my prediction of 4 weeks was a slightly optimistic, but not completely off. If we sort of like head for just after Easter to see a deal, and Unilever was, it's a perhaps a chunky enough deal that it might not be privately placed.
Yeah, there's a big pipeline. We published something yesterday. Just look at our usual forward calendar for March for the week, and there are a lot of deals waiting to be launched. So there's no lack of deal flow. It's just when issuers are ready and what is the price.
Let's pop to the next slide, which is CLO volumes. But before we talk about CLO volumes, the feedback I'm getting is arrangers are open to do deals. I'm hearing possibly half a turn less of leverage, possibly a percentage more on the yield. And of course, as you and I have talked about a lot, direct lenders are apparently making hay while the sun shines and open and, pricing obviously up a little bit, but, completely open for business and doing quite a lot of business. So this will really cement direct lenders as a portion of the market that we're seeing.
Yes.
So let's have a look at CLOs. So a few deals done, because obviously sometimes your warehouses mean, just like in COVID, it's better to actually print a deal than it is to sell all your warehouse in the secondary market. So Investcore at 110 on the AAA, Hayfin 107, Palmer Squared 105. So, up from 92, which is where we had as a low pre the war, but still pretty good. Those prices aren't bad considering you're raising most of your stack at the AAA level. So this figure shows March issuance down dramatically on February, but the CLO market hasn't closed. I think what has occurred is perhaps possibly some of the refis and resets are being held back a bit. But there's some primary stuff going on.
Yeah, and I think that's what is driving the secondary buying in the secondary market. We had a bounce at the end of last week, where we hit a post invasion low of 96.12, and then by Friday it was up to 96.52. So there was some support later in the week from buying, and I think that is really from the newly printed CLOs driving up.
So if we go to the next slide, which is AAA CLO spreads versus term loan B, I mean, obviously, because there aren't enough data points, that single B term loan B spread line hasn't adjusted. I think you and I would expect it to, I'd certainly expect it to jump by potentially 100 basis points. And if you consider where AAAs are, and you should look at the weighted average cost of capital across the stack, that technically means that the arbitrage is getting better. So that's good news for CLOs.
This data has a bit of a lag, because even the AAA spread pricing in this chart isn't going to, because we calculated this on earlier in the week, that it doesn't show the fact that we've had those deals priced a slightly wider AAA spread. So unfortunately, we kind of have to wait until next month to see if we get a sort of more accurate pricing level, just because we don't have that many deals on the primary side, and it hasn't filtered through yet with the CLO pricing. But
you know what a CLO manager said to me the other day? You remember we've talked earlier in the year about there being around 60 warehouses open. They're still there, and they will come to market, and apparently hats off to the arrangers who've arranged those deals, because apparently it is quite shifting sands with orders when you do a CLO at the moment, and some people will say, I might be in, I might not, ask me the day you syndicate. Apparently it's quite difficult to put a syndicate together, but they're being done, clearly, because we've seen these three issues. And let's go to the next slide, which is average yield to maturity at issue for single Bs. Again, reflects what we've said in the last slide. This shows pricing coming down, which was happening before the war. It will now jump post,
Mhm.
the war when we pop out the other end. And then let's go to the secondary slide, or the beginning of them. Weighted average bids of European loans. Now, you did some digging around about what you think is going on in the secondary market, because I'm super skeptical about any activity and where it's priced, but you've got some more feedback on that.
Yeah, this chart looks quite dramatic. It shows the sort of where we are relative to earlier in the year. Now, I think that the trading that is happening is quite thin, but it is happening, and that goes back to the point we made about the fact that the new CLOs are coming in, and it is the higher margin credits that are insulated somewhat from raw material costs, energy prices. So I was talking to David about this yesterday, and he's talking to lots of people in the market, and they were saying that the names that did get beaten up, there was lots of demand for them. It's easier to buy, harder to sell if you want to sell, and it is going to be the first beneficiaries of this bear cash, just because there's no primary market to speak of. So, everyone who has cash is looking to secondary. And the other point I just wanted to make is, if we go to the next slide, again, the exact same data, but a longer time series, just to see where we are relative to the COVID drop. And, before the pandemic, actually, like, to put this in perspective, before the pandemic, we hadn't seen the weighted average bid go below 97 since July 2016. So if you look at it over time, it doesn't look like we've dropped that much since the pandemic. But actually, we haven't, before the pandemic, we hadn't been below this level since 2016. And I think if you look at returns as well, we had such a positive run in for the Ellie in terms of the returns that we've been posting. If we
So
go
let
to the next slide.
me go to the next slide. Sorry, Taron. So the next slide is monthly return by asset classes.
Yes, exactly. And so we had 22 months of positive returns, and February was the first time in that time period that we went into negative territory. So the return for the month of February was negative 1.1%, excluding currency. And you can see in this chart as well that everything was negative. The equities line you can barely see because it was just slightly negative. But I think, managers are focusing on portfolio analysis, managing their portfolios. We would expect that we would see negative returns in February after everything that's happened. But, like you said, the market is much more mature. It is more of a capital market. So we are going to see a pause in activity. But hopefully, we will see some deal flow returning in the coming weeks.
Yeah, no, I completely agree. I mean, I must admit, you and I talked about the secondary market, and my personal experiences of the secondary market go back to 2008, where it gapped down to 80, and then it actually gapped down again to 60, and it all bounced back. And I think in COVID, where we had that previous graph, it did gap down to 80. And I was wondering if it was doing that again, because of course secondary trading is super thin at the moment, and it's to order and all that kind of stuff. But from what you're saying, it's not. It hasn't fallen that dramatically, which is quite interesting. Perhaps certain selective credits, but not on the whole. So I guess to summarise, tell me if you disagree. To summarise, might be the odd quote unquote privately placed deal in loan world before Easter. If we're lucky, might be some more broadly syndicated loans coming out just after Easter. There is a big pipeline which has to be syndicated at some point. There's still appetite from CLOs. There's a lot of appetite from direct lending. Perhaps leverage may stay stable, may go down a little bit. Perhaps pricing will go up by 75 to 100 basis points. Do you disagree, Taron? Do you think
No,
that's accurate?
that was a good summary.
Thank you.
Yeah,
Okay.
yeah, no, I think we will see. And yeah, it's just strange times again. I mean, we've had we thought we were coming out of this pandemic only to be hit with a very difficult situation, and yeah, in Ukraine.
Well, so there's the war in Ukraine, but also actually COVID numbers are rising again. So it's a bit of a double whammy actually at the moment. Right, on that happy note, we wish everybody well. As ever, if anybody has any questions, feel free to phone us or email us. Thank you very much.